Good morning, everybody. It is Jackson Hole Day, August 27th, 2021. So we are going to talk about the dollar a little bit after we just watched Fed Chairman Powell give his little speech this morning. And I don't even know that he did many questions and answers. If they did, it wasn't on Bloomberg. I'll have to read up about it. But essentially, Powell said what we thought he was going to say, which is, hey, we're going to taper, but we're going to be really nice about it. I have no idea what that means, but we should take into context what happened last time. He tapered. He was talking about more tapering a couple of years ago, and then bam. I mean, like 2 months later, he was loosening up again. And then by the following September, because of the repo crisis, he was doing stealth bailouts. Now, interesting. The repo markets have had some problems lately, but the Fed created a $500 billion bailout facility. They're not calling it a bailout facility, but that's what it is. So the Fed is going to have a $500 billion standing by just in case there's problems in the repo market. And I think that's very important because it's a clear sign that they are getting ready to taper, right? We're going to taper, but we're going to keep this $500 billion over here to make sure the banking system doesn't seize up. So what does that mean? I think that means that you're going to see a lot less liquidity in the stock market, and that lending facilities for the purpose of building stuff, rebuilding the world, moving supply chains back home, these are all things that we've talked about for years now. The banking system is going to be ready for it. I think there's a very good possibility that if the stock market corrects a little bit, it'll give Powell and Brainard, who's probably going to be the vice chair in January, a chance to say, hey, to the banks, don't buy back so many shares and give out such big dividends. We need you to loan money out to companies who are building stuff and doing things. So we'll see. We'll see. You know, there's a lot of people out there that don't want to see bank stocks as growth stocks. Really, we want to look at them as a financial utility. And I think that's the way that you should think of them. Bank stocks and utilities, I think you think of them the same way going forward because the banks are more and more regulated. And there's these waves where they're less regulated and then they screw things up. I don't think you're going to see the banking system as freewheeling as it's been in the past. And I think that the regulations are leaning, especially with Brainard going to become the vice chair for regulation. I think you're going to see the banks a lot more interested in making money on the spread on their loans versus buying back their shares. So I think the Fed's going to tell them, hey, lean in that direction instead of that direction. So for those of you who like to invest in banks, remember my refrain from the last couple of years. Don't ever invest in a big bank. Just don't do it. Never, ever, 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 ever. Why? Because if it's good for the banking system, it's better for Apple and Google and Microsoft. So you're better off owning Google and Apple and Microsoft than you are any big bank in existence. Now, that doesn't mean don't find little banks that have specific niches that are undervalued and you think can pay a big fat dividend and then get bought by somebody and make some money on a small bank. There's small banks out there that are worth buying from time to time. I haven't bought any small banks in years. But I did make very good money on a few small banks. And there's one in my community that I keep an eye on. I just always wonder, man, this bank is in such good shape. If this family, and it's a closely held bank, it trades publicly, but it's closely held. If this family ever really wanted to really monetize the shares, how would they do it? And I've thought that through. And those are things that you can think about with small banks, because a lot of the small banks are closely held. And you say, okay, if the family or the controlling group really wanted to monetize those shares, how would they do it? The problem is that buying the shares is usually really hard because they're thinly traded. So you have to do it over a really long period of time, which really doesn't make it appropriate for a service like this. Say, hey, buy little itty bitty on the corner bank that deals with farmers and whoever, because we would drive the share price up and there'd be nobody else to buy our shares. Unless they sold the company, in which case we may have bid it up already to the price it needed to get to. So there's just not a lot of banks out there to ever invest in. And I wanted to reiterate that because I know there's new people who are going to be listening to this. We got about 30 new subscribers this week. And I just want them to understand banks are bad as investments. They just are. If you take a look at the waviness of them over very long periods of time, yeah, you can trade them a little bit, but there's better things to trade. And yeah, you can get dividends, but there's better things to get dividends from with less risk that are less economically sensitive. And if you really just wanted a bank-like stock, right, because they had bank money, buy the basket of NASDAQ stocks and a couple others that are at the top. It's about 20 companies in the whole stock market that control about 70%, 75% of the money. It's not a joke. There's only about 20 stocks that control most of the money on corporate American balance sheets. It's Microsoft, it's Apple, it's Google, it's Facebook, right? That's why you see Facebook keep trying to do different things, because they know that the whole social media thing is calming down. So how do they monetize what they've done already? All right. So why am I talking about banks? Because I'm going to talk about the dollar, and the dollar is important to banks. The dollar is important to the stock market. The dollar is important to everything. Ultimately, the Federal Reserve's main job is to protect the dollar. That's really what it's all about. So when you have somebody like Jeffrey Gundlach going off this week saying that the Fed's going to destroy the dollar and the federal government's going to destroy the dollar, you have to realize Gundlach hasn't been right about a whole lot of things for a whole long time. And why is that? Because he's stuck in that whole Austrian economist mindset. This idea that the United States isn't different than the rest of the world, which is bullshit. It's an introduction to our farmer words, seeing as I'm always just a few miles away from a farm where I live. Look, the United States is special. You have to always keep that in mind. Go back to studying Alexander Hamilton. He realized it. He's like, look, we have this huge geographic advantage. We have the potential to be an economic powerhouse. So I'm going to set up the system to make sure that we can be an empire. And that was something that I think people miss with Hamilton in the musical if you're not really paying attention. Hamilton's goal, and watch the John Adams thing on Netflix. That's real good. Hamilton wanted the United States to be the next Great Britain. But he saw that with our geography, we could be way more than Great Britain ever was or England ever was. And he was right. So we have an economic system that is set up to give us power all over the world. And there's been a series of decisions over the last couple of centuries that have just kept pushing us in that direction. And one of the things you need to ask is, okay, what is the next thing we're going to do to keep the dollar as the reserve currency, because it is the free ride of the planet, the reserve currency? What are we going to do? What was the last thing we did? We cut a deal with Saudi Arabia, the petrodollar. And there's smaller things in there. But what are we going to do to make sure that the dollar stays up here rather than falling down here and giving us real inflation? And we've talked about this. It's probably going to be the digital dollar. And they might build in some non-Federal Reserve tinkering rules when they introduce the digital dollar. Maybe the digital dollar won't be controlled by the Fed, but it'll be co-controlled by the Treasury. When we think about things like stable coins, we realize, hey, the stable coin might be a real thing because if you regulate them like money market accounts, then they have to buy what? U.S. Treasuries. Cha-ching! So if the digital currency infrastructure, the cryptocurrency infrastructure, incorporates a way to increase demand for ultimately U.S. debt and U.S. dollars, maybe debt's not that big of a deal. Alexander Hamilton said, we want to have more debt because that gives us more credit, which makes us more important. That's Hamilton, hundreds of years ago. What did Dick Cheney say in the early 1980s when people were starting to fret about debt? He said, debt doesn't matter. And that's one thing I want to get out of the minds. It's one of the things I want you to unlearn if you think that that's going to crush the economy and crush the United States. We would have to go way overboard to crush the United States dollar. To crush the US dollar would be very difficult. And a few trillion dollars just doesn't matter when the value of the assets in America are worth hundreds of trillions. And again, if you think about it at the household level, which you shouldn't, but I know it's easy to do, if your house was worth $300,000 and you had $270,000 in mortgage against it, you'd be like, I got to get that paid down. But wait, what if you had other assets worth 3 million or 30 million, 300 million? Well, the United States is worth no less than $300 trillion. And it's probably worth, I think we're probably closing in on a quadrillion. When you take a look at all the numbers from the CIA, from the Federal Reserve, the US Treasury, where the money is, what it measures, what it doesn't measure, all the things in this country that don't have a dollar value assigned, and that's what you got to think about. So let's suppose we're only worth $300 trillion. That's the low end of the range. We have $27 trillion in debt. A 10% debt ratio, maybe 9% debt ratio. Does that really matter to you? Does that really scare you? Because it shouldn't. And let's think about all the other things in the world that would be traded in dollars or that are here that don't have value assigned. The educational system, right? What is Harvard worth? Is that on our balance sheet? What are all the school systems worth? What are the hospital systems worth? Are those really on our balance sheet? What is the real value of our skilled labor force? When you go through all those things, you think about velocity of money, what you realize is that a dollar in one hand that moves to another hand, and they spend 80 cents of that dollar they received, then the next person spends 80 cents of the dollars they received, you start to go, we probably are worth triple or quadruple what it looks like. And in that framework, that doesn't matter very much. Not unless all of a sudden we ran up $100 trillion debt, right? So when Gundlach says we're going to crush the dollar, maybe cyclically we go down here and there's a little mini crisis. And then we have to do things to fix it, and everybody gets mad, and we vote for the wrong side, and then the wrong side does something else that's stupid, but it balances out. The two stupid things kind of work out. We tick-tock from the left to the right. We're dumb that way. If we could all reach the center, probably work out even better, kind of like the 80s. A guy named Tip O'Neill, right? Even when President Clinton was in office, had this Gingrich guy or something cut deals with a Democratic president or a Republican congressman cutting deals with a Democratic president. Yeah, weird, crazy stuff, right? Crazy stuff. Democrats and Republicans figuring out a way to get close to the center. Ooh. Go yell at somebody on Facebook and get a 3-day ban like I did. Can't have that. Can't work together. They're evil. No, they're evil. They're evil. They suck. They suck more. All bullshit. I'm going to tell this story here right now because I've told it before. I know a lot of people haven't heard it. I was interviewed by Breitbart after my days with MarketWatch because I was mainly an oil analyst over at MarketWatch. Talked about technology, but they wanted me to talk about oil. So when I was done with MarketWatch, because they shut down that section, went to a different model, I saw that there was a job available with Breitbart. I was just curious. So I applied. And I got through the first 2 interviews, and they basically offered me the job. It was a big 6-figure income with upside, book deal, potential TV show, or internet show, a lot of stuff. Total compensation probably would have been over $1 million a year if the book got done. But wait, there's more. There was a catch. I had to be a climate change denier. But do it. Actually got to the point where Steve Bannon was on a call with me for about 5 minutes. He said, well, this is what we would expect from you. Doink, 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 doink. And I hemmed and hawed a little bit because he was pretty explicit. I said, I want to go where the evidence leads me. I mean, the evidence is probably the climate change is happening. I don't know that I'm entirely sure how it's happening. I was pretty sure. I'm pretty sure we're doing it. He didn't like that answer. So the contract, they emailed me to review Within 2 hours of that interview call, I got another email saying, hey, disregard this. We're not going to make this offer. Behind the scenes of the media that you get, especially the alternative media, there's a lot of money in play. Click, 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 click. Right? Eyeballs. Click this, click that, click the other thing. Watch our show, watch our advertisements. Do this, do that. Most of the alternative media is undereducated, inexperienced at actually providing news coverage and finding facts and double checking things. You know why? Because it's not in their interest to have people that can do that. What's in their interest is to have crazy headlines to get people to look at it. So when you see headlines on hyperinflation because the dollar is going to crash and it's the end of America, what's the word that you really should use? We just reviewed it a second ago. Farmer's words, bullshit. Ultimately, you should always come back to what my grandfather said to me and what yours probably said to you, or an uncle or somebody said to you. If you really want to know how things work and why they're done, why they are the way they are, follow what? Follow the money. Damn right. So I want you to really unlearn some of the things that you may think that you know about debt in the United States. I'm not saying that we should be modern monetary theorists and just print. What I'm saying is that when they say they want to spend $3.5 trillion to fix the system, make it easier on the middle class, provide a safety net, provide education, provide childcare at a discount for people who have low incomes, that's not a big deal financially. $3.5 trillion commitment from this country to fix the little things that ail us. And really, they've become big things because we've ignored them for about 35 or 40 years now. It's not that big of a deal. The infrastructure deal only provides $0.5 trillion extra dollars. Did you know that we're between 20 and $30 trillion behind on infrastructure deferred maintenance? Talk to any governor. I had a cousin that was the Secretary of Transportation in Wisconsin. Talked to him pretty frequently, actually, at the time. He's retired now. He travels a lot. I don't talk to him much anymore. He's one of those relatives. It's weddings, funerals, maybe a holiday. In any case, if you ever talk to any of those people, what you realize is there's so much work to be done that it's unbelievable. We could employ everybody that's unemployed for 30 years trying to catch up. So a little infrastructure bill and the reconciliation bill is going to try to make it a little less easy for the super wealthy and a little more easy for everybody in the middle class. Yeah, don't buy the hype, because ultimately the debt that creates is minor. And if they close the carried interest loophole, if they raise the corporate income tax from 20 to 25% and the capital gains rate from 20 to 25% for people making over $1 million, they get rid of the step up in basis on inheritance over $1 million. If they actually enforce the estate tax and not let people ditch it, does that affect any of us? Yeah, it does. It's positive for us because it evens out the playing field, and we've been playing against the house for a long, long time. You know, I'm a professional gambler. Not really, but kinda. And I'm a semi-pro poker player. Semi-pro meaning that I can beat amateurs, but the pros remind me that I'm not really a pro. Gambling systems that are out there, a lot like the investment systems that are out there. We want to focus on a couple of things. One, the value of the dollar. And the value of the dollar is impacted by what the Federal Reserve and the Treasury do. If we understand that, and we understand the correlations between liquidity and the stock market and inflation and deflation, then we're going to be a leg up on everybody. Because 90% of the population that invests doesn't even think about that. They don't. And ultimately, in a world where there's a lot more people trading ETFs and they only buy until they get scared and then they all panic sell, you can build an investment thesis around that. Why buying the dip has been so successful? It's because money just keeps on chugging into index funds. And when we get the rare occasion that there's a correlated correction, you need to buy those 20 or 30 stocks to control the market, at least the large cap indexes. And again, for the new people, I believe that 90% of American companies are uninvestable. You should not even look at 90% of the stocks out there. So if so many people are indexing, what does that mean? It means that some crummy stocks are going to go up for periods of time. And then when the market sells off, they're going to get crushed the worst. And you have millennials, who I have told you for a couple of years now are the marginal money in the market. And really that became apparent last year. Millennials are the main buyers of stocks now. Baby boomers are almost at a point where they're about to become net sellers, right? When the last one hits 70, the boomers are never ever going to contribute inflows to the market again. Their pensions are paying out without taking money in because the younger people don't have them. My X generation is small by comparison, only 2/3 in size to the other two generations, boomers and Xers. And if you've read my slow growth forever thesis from years and years ago, and you should, if you haven't, you should. I will actually update that report by the end of the year, or by January, probably by January. You have to realize that because of demographics, deflation is really the boogeyman. The big move in the emerging markets into the middle class is half over, basically the China and surrounding area half. And it's moving to India and Africa and the Middle East, parts of the Middle East that haven't already done well, Iran, Iraq, things like that. Some of the, we'll use one of Trump's phrases, some of the shitholes on the planet are going to actually get better in our lifetime. Some of the other ones won't. We'll see. We don't think about investing in those anyway. Just like I don't really invest in China and Russia. Why? I can't trust them. And I might get some of their stocks inside of an ETF, but I'm never going to buy an individual Chinese or Russian stock, because I could wake up one morning and Xi or Putin could say, hey, I want to have that guy killed, and crush their stock. It's a thing. Why take that risk? Right? I'm dumping a lot out there right now. But back to the dollar. If it stays in this Goldilocks zone, not much changes. If it goes too high, we usually see a steady decline until we get to crisis level. Up here, especially above that line, the dollar creates downdraft in asset prices. Why? Because the dollar is half the money on the planet, and it pushes prices down when the dollar gets strong. Think about it like you're a traveler. If you're traveling from America to go to Europe, like Teresa is, our resident historian, I guess she'd be. So every week she puts out a highlights from the chat room. That's Teresa. She's in Italy, or on her way to Italy for her daughter's wedding. Now, if the dollar is strong, it's a cheaper trip, right? If the dollar's weak, it's more expensive. Same thing with stocks and real estate. The dollar's strong, the assets cost less. If the dollar's weak, the assets cost more. So if Fed's going to taper, what's going to happen to the dollar? And remember, what did I tell you? When we were close to the election, I said that if Biden gets elected, it'll mark a bottom in the dollar for a while. So far it has. So the dollar is probably going to drift up here, somewhere in this range. If there's some sort of a shock to the system, it'll go a little higher, and then it'll start coming back down. So as the dollar peaks, wherever it's going to peak, probably in here somewhere, asset prices come down. That's why I'm saying we could have a 20 to 30% large cap correction. Small caps have a lot of small caps already experienced that. And that's why I'm finding some value in the small caps already. But the large caps, as the dollar goes up, they'll get cheaper. And that's when we can buy Microsoft and Google and Apple and Amazon on the cheap, relatively speaking, and some of the other ones we want. And I will say QQQ is the absolute easiest thing to have as a core holding in your portfolio. Why? Because 40% of it is Apple, Microsoft, Google, Amazon, Facebook. And 4 out of those 5 companies hold it's some weird percentage. It's like 40 or 50% of all the cash on corporate balance sheets in America. That's how rich those companies are, which is why I say you'd rather own those than banks. So if you're on this notion that, hey, what about Bank of America? No. What about Citigroup? No. What about JP Morgan? No. Just buy the QQQ top stocks. They have more money with faster growing businesses and less economic downside. So lower risk, more upside, and more cash. I hate that. All right. So a dollar is going to drift up. Stocks are probably going to drift down. I've been trying to model out what I think stock market is going to look like over the next decade. And inevitably, this is going to be wrong. But it's a framework to work with. I think the stock market is going to top out, correct, top out, correct, top out, correct, breakout. From an Elliott wave standpoint, we should probably talk about that. So let's try to bring on Shooter.
Hey, bro.
All right. So I know this is an Elliott wave format. What does that look like to you? But this is your waviness, right? And you see that the low points are coming up. And if I'm right, the high points will stay about the same.
Yeah, they should be staggered, but moving up slightly. So you'll continue to put in a higher high and continue to put in lower lows. So each step further into the wave, they become broader waves.
And that usually means one of two things. It always means one of two things, either a big breakout or a big breakdown. So I would anticipate that we'll keep getting our little higher highs, but our lows will also get higher over a long period of time. Now, in the short term, it zigzags down, usually 3 waves, occasionally 5 waves. And there's different patterns in Elliott wave that can do different things, which is why for short-term traders who are trying to systematically trade, you can put the odds on your side, somewhere in the range of 2/3 to 80% of the time. Depending on how good you are. Shooters closer to 80%. Other people are closer to 60%. But if we get a 3-wave down and it doesn't turn into Armageddon, then we'll get our 5 waves up. 3 waves down, 5 waves up, 3 waves down. But our highs are only getting a little higher. And remember, curves, the market really curves, right? Exponential thinking. Eventually out here in about a decade, give or take, we'll get a breakout point to really higher highs. Now, that's one way to look at it. That's how I look at it, because I think that time and inflation are going to have to fix valuations, because valuations are out of line in the large caps. There are a lot of companies in the S&P 500 that are zombies. So as the small caps cross the $10 billion threshold and can be considered for the S&P 500, and as other companies, many of the energy companies, shrink, or companies that just aren't as viable anymore shrink, they'll fall off the S&P 500. And when the S&P 500 has replaced enough of the zombies, it'll really break out. Now, liquidity plays a big picture in that, big part in that, because more liquidity pushes it up, less liquidity pushes it down, less liquidity makes the dollar stronger, more liquidity makes the dollar weaker. So asset prices will move with that. One of the things that I covered in this week's retirement income options article, and for those of you who asked, retirement income options at fundamental trends is essentially the same as margin of safety, right? The rare membership here includes Shooter's swing trading ideas. So here I covered all kinds of stocks that were overbought, and then I did a separate analysis whether or not they were overvalued based on the next 2, 3, 4 years of earnings. All these stocks are overbought right now on a weekly chart, so many of them on monthly charts, and are overvalued. Almost all large caps. Cash secured puts were based on ideas where the company is oversold on a weekly chart, and I feel are undervalued based on what I see happening in the next 2, 3, 4 years. Really can't go out much more than about 5 years because the world changes, right? So these are all companies that I'm excited about because I think that they can go up 300, 400, 500%, maybe 1,000% in value over, 5-ish years, 10-ish years, if things go well. But for sure in the next 2, 3, 4 years, I'm pretty optimistic about them. And my criteria here is that I think they got a shot at a triple in under 5 years, all of these. So the combination of undervalued and oversold makes me want to own those. So here we have Shooter's chart. So let me bring him back on. And we are looking at his QQQ chart. So this is the QQQ weekly chart from Shooter. You there?
Oh, yeah, I'm here.
About time. All right, so let's.
I still see the dog on your screen. I've got you blown up on my screen, but
all right.
Now I'm seeing me and not you. I don't understand this.
So we have the QQQ weekly.
Okay. So just jumping into a little bit, we actually are above the count. The count came in about 374.33 this morning, just before the open. So we pushed a little bit above that. I don't know that we get I put our range in between that 338 and 365 because I think the low side holds. Powell didn't destroy us, which is a good thing. But as I look at the market now, we're sort of fading off of that a little bit. So I don't think we get below that 61.8 and then we continue up towards that 373 looking at the weekly chart.
Right. So this kind of coincides with my thinking that we could go higher. But into tapering, there's probably a point up here that creates this downdraft here. I think that's what people need to pay attention to. So here's the daily chart on QQQ, so you get a more micro view of what's going to happen in the shorter term.
Right. Now that 365 on the daily chart, that is the count there. However, if you go down on the shorter time frames now, the downside has ended, down on the 1 hour and the 4 hour chart as well. So that's just, one thing with different degrees and time frames that you look at with Elliott Wave is you have different counts. So stepping down, sometimes you get a little bit of noise. So you sort of have to, guess which is going to be the range that you're going to stay in. So that's why that 365 low is there. But I think the bottom's in at this point.
Right. So you see RSI turning over down here.
Yep.
And so it's already corrected a bit.
Yeah.
And you're saying that it's probably going to pop back up here, at least in the short term.
Yeah.
Okay. So on the S&P 500 weekly, again, it's interesting that we both have similar downside. I'm thinking 350, maybe all the way down to 300. But 350-ish is kind of what I'm thinking based on valuations and the way that I, chart out. You're saying 350-ish too if, once we top off.
Yeah.
What do you think?
We're just going to chop around, and I think it'll be a slow grind a little bit higher unless we need a catalyst to bring us down. And honestly, if we didn't sell off in Asia off of the Afghanistan news, I don't know what would cause us to sell off.
Yeah.
Maybe a half a point rate hike.
I mean, there is a little bit of trepidation with Afghanistan, but I think that most people realize it's not that big of a deal. I mean, from an economic standpoint, it just doesn't matter. We're not really tied to Afghanistan in any economic way. So.
No, it's the only downside that I see there is that there was a lot of bashing yesterday on Biden, and if China starts bashing Biden publicly over there, it will, a lot of people will pull their capital out from Asia. And a lot of people don't realize that's significant because, whatever it is, 20%, I don't even know what the percentage of the S&P is owned by, by Chinese folks, but it's a chunk, and, if they decide that we have any weakness or there's, it's our stability is at risk or whatever, then they start selling. And we've seen that, right around the elections when, negative things happened, the Asia markets would sell off U.S. equities and then we'd gap down the next morning.
And that's why I don't trade day to day. But the idea here, I think, would be if we get that sell off, it's probably a pretty big buying opportunity.
I agree.
There's just not any end of the world events that we can see right now. I mean, the mortgage markets the counterparty risk in the mortgage markets is not high. And that's the thing that happened during the financial crisis, that the counterparty risk was really high. We've basically fortified the counterparty system. And now that we've backed up the repo market with $500 billion just to make sure the banks don't get any of the short-term headaches, we can help them work through any short-term headaches. I mean, could there always be a war? Could there always be something just out of the blue? Absolutely. That's why they're called black swans, is you don't see them coming. However, I will say, if the Federal Reserve gets the more robust regulatory people in there over the next 4 months, 5 months, whenever it is, by January is when they're all getting appointed. I think that the banking system is fairly stable. We have more money than we could use in the short run. And the people who are talking about imminent collapses and things like that, they've usually been wrong. I call for corrections here and there, but I don't think that the economy has any really gigantic problems until that last baby boomer is ready to get Social Security. There is a retirement system issue coming 5, 6, 7, 8 years out. Hard to know exactly where, but even that'll be a buying opportunity, because when it goes down, they'll come in with the Retirement System Rescue Act or the Social.
Yeah, they'll just remonetize it.
Yeah, the Social Security and Medicare make you feel better about the World Act, whatever they call it. But someday they're going to fix that. And interestingly, part of the reconciliation bill, if they do it, is to shore up Social Security, and it actually could prevent any Social Security problems for 100 years if they do it. And it's minor. It creates a donut hole in Social Security taxes. Right now, at $142,800, you stop paying Social Security taxes. And what they would do is at $1 million, you'd start paying them again. So there'd be a donut hole. And I think that that's really good for your upper middle class people who are working and trying to invest and getting into new things with their new money. But it also puts the burden of that last little gap in Social Security, because there's about a 20 to 30% gap in Social Security starting in about 2 decades. So Social Security is 100% funded for the next, whatever it is, 15, 20 years. It's only about 70% funded from about when I'm supposed to get it to the end of the century. So they have to fill that gap so that I get my extra $500 a month. And they'll do that, and they're going to put it on the back of millionaires and billionaires. So, that's what's coming in reconciliation. I think, and this is a point that I've made before, is that we are pulling forward the bailouts of the future right now. And you got to remember, the economic gap caused by coronavirus is less than the amount of stimulus created. Think that through. The economic gap, which was whatever it was, $1 trillion, $1.5 trillion in the United States, about 6 trillion, 7 trillion globally, is I believe the right number. I could look it up. But it was under $10 trillion. Well, the governments and central banks of the world have put like 20 or 30 trillion, depending on what you believe, into the system. Well, why would they do that? It's because they know that the slow growth forever thesis is right. And they know that there was a retirement system issue coming. And so they're addressing it now. They're saying, hey, why don't we prevent that next crisis? Plus, it pops up stocks, which makes everybody feel good. There's a pretty tangled web, but I guess my point would be, now that I'm not worried about somebody in the presidency having a far right-wing Congress, I'm not too worried about the system right now. Now, can people, say, well, I don't like this or I don't like that? Sure. Yeah, I'm not a big fan of Biden. I'm not a big fan of politics in general. I think most of them are self-motivated. However, the reality is that when we stay close to the center, things work out. And the fact that they're pulling forward bailouts for the future to today to avoid those crashes of the future and economic issues of the future, I think is actually rather smart. I talked about 2 years ago, 2 or 3 years ago, they wrote policy and created laws and a structure for bailing out the pension systems. They haven't funded it yet, but the laws are actually in place to bail out the pension system should it need to happen, and it probably will. So when we look at investing, again, all big corrections should be bought. And I should have been way more aggressive last April. I mean, I picked out some great stuff, but I should have been 150% invested instead of 70% invested. Now, when these dips occur here, so we're on the daily S&P 500 chart, I would think that if the Fed is tightening at the time or unloosening, because I don't know that it's really tightening, it's just less loose, we'll probably look for some of these lower levels. So as we go over to, I'm going to skip over the Dow Jones Industrial Average because I don't really care about that index. It's tradable though, so if you're a rare member, you want to take a look at that. I want to take a look at the IWM. So Shooter, it seems to me that this has been basing for a long time now.
It has been.
And I think that valuations on some of the companies are really good.
Yep.
So what's the index going to do, and how's that going to impact some of the stocks?
Well, fundamentally, I think that from an Elliott wave perspective, we have not completed the wave 5 down, which is what we are in. So that 201 to me has to be tagged. Otherwise, anything to the upside is noise for me because it's likely to come off fairly quickly. Just looking at this, and we saw a push. Today, going into Jackson Hole, and it's, but I still expect it to come back, even though I have counts up there right now where I have a 223 and then 236 up there, but that all could be noise. We're still, I'm seeing that in a lot of tape. It's very difficult when you have the buyer and seller emotions coming in so aggressively. Elliott wave is a reflection of that. So, interpreting that in both directions is what is noise and what is a real count. And so ultimately, I'm still going back. That 201 has still not been tagged. I won't get comfortable long, with any decent size until that gets tagged, in short.
So you're thinking that IWM has one more leg down, basically?
Yep.
Okay. All right, so we're at the TLT daily chart.
Here again, the noise is crazy. I was just getting ready to put on a short, and then the count this morning flipped. So I'm sitting on my hands there again. I mean, it's when there's that much noise, I just can't. I have no future view. So there's until it calms down and I get some, stability in the counts. It's very hard to go in either direction.
So over the last few weeks, I've told people there's just no trade to make here. The easy trade on TLT was way back in April and May. And I just think that, you could have rolled the trend for a couple months, but now we're in a choppy period. And if interest rates tick up a bit, right, then TLT comes down. So we have to.
Yeah, that triangle actually extends out to the end of September. So that is the most likely point where we make a decision on which way we're going to go.
Right. So folks, remember I showed you that my S&P 500 chart. I said it'd come up, come down, come up, come down, come up, but it ends up being a triangle, right? And as these points get closer to each other, there's got to be a decision made by the market. This is the same thing that I think over the very long term could happen with the S&P 500. So as the zombies get pulled out of the S&P 500 over the next 5, 6, 7, 8 years, especially as their debt comes due in about 4, 5, 6 years, because the Fed refinanced a lot of their debt for them or facilitated it. Companies that have to face debt repayments as there's those bonds come due in the middle to late in the decade, could create this pattern that I was trying to show you with the S&P 500. Now, it could create a big downdraft, or it could be a breakout. I would bet on the breakout because there will be a lot of new companies coming in that'll start getting S&P 500 dollars, right, from the indexers.
Yeah, we're looking at probably a 1.75 yield by year end, I think. So that should weigh on TLT. Yeah,
I think we'll make another run at 2%. So so we're looking at the GDX daily chart, and I significantly lightened up on my GDX. I have just basically a starter position at this point.
Mm-hmm.
And it's down here chopping around 31-ish. What would it take to drive it down into that middle 20s area?
We'd have to have a complete breakdown. It's because I think the lowest we're going to see on GDX would be 28. My gold counts, on the futures, is relative to that. We see a little downside, that 1640 area on spot is about where we're at. I don't think we see below that. I think that ends up being a bottom just with how this is manifesting here. The one thing that I like about this chart now, which, we really have a double bottom in. So until we close below that 8-day, that's not negated. So we actually have a decent shot for, the 200-day around 35 here. But there's still a lot of noise in commodities, and what we're seeing with the orders down. We could have some way to go if the delta really gets hold and the efficacy drops in the vaccines. So I think we're going to see more shutdowns, which will ultimately affect gold. So,
well, I have been thinking about selling puts on GDX again, just to collect the premium, because there's a lot of premium in it because it's volatile.
Yep.
And I would probably sell 28s if I could get a couple bucks for them. I have to check and see what those numbers are. But selling the GDX puts, and if you reduced up here when I was talking about it, you've got $4 or $5 of room to play with. So yep. I think you can sell those puts just because of the tightening and the dollar getting stronger. I don't want to get too aggressive because GDX, which is the gold miners, is about 60 to 70% correlated to the price of gold, and about 30 to 40% correlated to the S&P 500. So if the S&P 500 falls out of bed, this is, it's going to get hit. But then it probably rebounds really fast.
Here's your sign. Close below 31.35, you're out.
Okay, so that would probably drive down to 28. So we're right at a decision area. And what's the best thing about decisions? You don't have to make one. This is like a baseball game. I think some guy in Omaha said something like this. It's like a baseball game where you can take as many pitches as you want and you'll never strike out if you don't swing. So I think this might be a spot where you don't swing. I think it's probably too late to trim, but it might be too early to add. All right. So just because I'm an Ethereum bull, tell me about Ethereum.
It looks solid to me. It really does. We keep pushing a little bit on, originally my count was about 3,400. Now it's pushed up to about 3,547. And the longer we put in that, consolidation zone and that range low holds, that 29.52.12, the more upside potential it presents, to pop out of there a little bit, because we could get a breakout here. That could have some push behind it, just the way the RSI looks and the momentum as well.
Interestingly, I'm going to start using my PayPal account because I have subscription revenue that goes in there. I'm going to start using it to buy the Ethereum dips. And just so people are aware of what my long-term Ethereum outlook is, I believe it's going to be the cryptocurrency used in most NFTs. I know there's a couple other competitors, but they're not really close yet. So between Bitcoin and Ethereum, that is, 95% of all cryptocurrency value. Everything else is just, it's like throwing a penny at $100 bills. So between Bitcoin and Ethereum, those are the only two that I really want to focus on. I guess I might be missing out on something, but I'm not looking at Bitcoin and Ethereum as big speculative investments. I'm looking at them as ways to hedge against central bank inflation. For me, the digital contract world is going to be massive. I think it's going to disrupt real estate. I think it's going to disrupt everything tied to real estate. I think it's going to become a way of sharing ownership on artwork, on all sorts of things. So there are a lot of alternative assets plus real estate that I think are going to benefit greatly from NFTs and digital contracting, and Ethereum, Ether is really the backbone of that. So if you can buy a little Ethereum on the idea that, one, it has utility, right? That's your fail safe. It has utility. And two, that there's probably speculative upside. I think you can buy these dips on Ethereum, and I probably should have bought more down here when I was doing it, and I probably shouldn't have trimmed. But I think I'll get another chance to buy close to where I trimmed. And this is an argument for sometimes you just don't want to sell your winners. And that is a lesson that I'll leave you with today, is you're better off trimming your losers to raise cash than trimming your winners. Although you may still want to trim your winners if you think that they are dramatically overvalued. And some of the S&P 500 stocks are certainly dramatically overvalued. But I think that most of the small and mid caps, unless it's a meme stock, I think is probably, if it's a winner, it's a winner. Hold on to it. If you need to bring it back to 2 or 4% position, or even a starter position down, say like a 1 or a 0.5%, depending on what you're trying to achieve with your asset allocation. But I think that is an important lesson that I've learned over and over again, and I keep having to relearn it because I keep making that mistake, is you have to ride your winners, because all you need is a handful of big winners, and your portfolio ends up crushing the market. So I'll leave you with that. Shooter, thank you very much. I will get this.
Thanks for having me.
Yep. I will get this edited and have it up on Saturday. So,
great trading, everybody.
Yeah, have a good weekend, everybody, and enjoy one of the last summer weekends.